Hey friends, welcome to the SBNRI Investment Update. Before we begin, here's why this update matters, especially for every NRI and OCI living across the globe. Every month, factors like US interest rate cycle, crude oil prices, rupee movement, and global liquidity directly impact your remittance, Indian investments, property based decisions, and long term wealth creation in India. In the next few minutes, we will speak about what happened globally and in India, not just as a news, but what it actually means for your money and investment decisions as an NRI. Let's start with the global picture. US inflation has come down to 2.4%. Core inflation is also cooling. The direct implication is the phase of aggressive Fed rate hikes is almost over. Bond yields can stabilize and dollar strength may moderate slightly. But an important point, US 10-year bond yields are still elevated compared to pre-2022 period. This means liquidity has not yet become cheap. This will have a direct impact on US markets. Brent crude is currently trading in the mid 70s range. Crude is extremely important for India because we are net importer. The current account deficit is heavily linked to crude and rupee stability depends on the crude. Right now, crude is in a comfortable zone. If crude goes above 90, inflation pressure will increase. Rupee may weaken and fiscal calculation may get disturbed. At present, crude remains controlled, which acts as a positive macro cushion for India. Metal prices are stabilizing. Copper is strong, which signals global industrial demand. Gold is trading near high. What does strong gold indicate? Global uncertainty still exists. Central banks are diversifying reserves and safe haven demand still exists. For NRIs, gold behavior is important because it indicates dollar weakness and geopolitical risk. Now, let's talk about India at a deeper level in detail. The rupee is currently in a controlled depreciation trend. There has not been a sharp crash, but how is this possible? These are possible because of these three pointers. The first one is RBI's active intervention to control this. The second is forex reserves at a comfortable level right now. And the third is FPI flows turn positive in February. Yes, FPIs have deployed a lot of money in the Indian market very recently, and that's another reason there has been a control over rupee depreciation. If US yields remain stable and crude oil stays controlled, the rupee will not enter a panic zone. Rupee movement is important for NRI, especially those who are planning remittance or investing in India. There was heavy FPI selling in January or till January 2026. In the February, buying of more than 19,000 crores was seen from the FPI. But the deeper question is this a structural reversal or a tactical bounce? So far, it appears driven by cooling US inflation, improving sentiment from India trade deals, and returning earnings movement. Improving sentiment from India trade deals and returning earnings momentum. But sustainability depend on the US rate trajectory and global risk sentiment. Housing credit growth is now moderating. Over the last 2 years, housing loans grew aggressively during the low rate period. Now, RBI stance is neutral, rates are elevated, and urban housing demand is stable but not explosive. However, the deeper structure trend remains positive. Urbanization, premium housing demand, and strong real estate activity in Tier 1 and Tier 2 cities. Overall, bank credit is still growing at double digits. especially in retail and MSME segment. Corporate credit is slowly picking up along with the capex cycle. The government capex remains elevated. Spending is strong across railways, power transmissions, renewable infrastructure, and defense. Now, let's talk about private capex. Private capex is also selectively reviving. Power transmission companies record high order books. Renewable capacity is being added aggressively. Let's talk about the Q3 earnings. So, Q3 earnings grew approximately 14 to 15%. An important observation: this growth is not coming from just 4 5 large companies. Market breadth is improving. PSU banks are strong. Capital goods are strong. Industrial names are strong. Energy infrastructure is strong. IT and FMCG were slightly soft, but overall the earning engine appears stable. Now, a mature thought: is a housing bubble forming? Current data suggests something else. Speculative leverage is limited, household balance sheets are manageable, and banks are doing conservative underwriting. So, systemic housing risk appears low. Every macro picture carries risk. Current risk include crude oil spike, US rates surprising, AI disruption impacting IT and export, geopolitical shocks which may come anytime, sharp rupee depreciation. If these factors remained in control, India's macro stability should continue. If I have to summarize it for you all, globally, inflation is cooling, growth is stable, liquidity is expensive but not tightening further. For India, capex is strong, credit is stable, currency is controlled, fiscal discipline remains there, earnings are improving, FPI is coming back, they are returning. Short term volatility will come, especially in the form of sector rotation. But structurally, India's growth engine appears intact. For NRIs, the message is simple: the macro base is stable, currency is not in a panic zone, structural themes remain intact. Timing the market perfectly is impossible. Allocation discipline is important. I hope you have a greater information now about what is happening globally and in India, and I hope the decision making for anything which you plan to do with India should be a bit simpler for you. In case if you want us to come up with another video on a preferred content, please drop a comment below. If you still haven't downloaded the SBNRI, do download it for any of the investment related queries. The link to download SBNRI is there in the description itself.